Welcome to Wall Street Unspun with your host, Peter Schiff.
It's a giant bubble in search of a pin, and it's going to find one.
Are you confused with the ups and downs in the economy and what it means to you?
Don't believe the propaganda, and that's what it is. When you're listening to an analyst on a lot of these popular financial shows, you're not getting investment advice. You're getting propaganda.
Get ready to untangle the web of misinformation provided by the mainstream media.
These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stocks.
And now, here's your host of Wall Street Unspun, the president of Euro Pacific Capital, and a licensed broker with a passion for truth. It's Wall Street Unspun with Peter Schiff.
Well, hello, everybody. Welcome again to another live edition of Wall Street Unspun. I am your host, Peter Schiff, president of Euro Pacific Capital, and I am doing this show live back here in Connecticut. 888-678-9597, 888-678-9597 is the line to call toll-free to interject a comment or ask me a question. First of all, so the Freedom Fest, for those of you who joined us down there, it was actually pretty well attended. There were about 1,000 people, which was many times larger than the first one I went to. And I know they're going to have it again next year, so perhaps I will participate again. But again, I'm still in the minority. I mean, most of the people there at the Freedom Fest, of course, everybody there is philosophically, politically aligned with my thinking. They're all libertarians, laissez-faire, limited government, conservative types. Yet the vast majority of them who are investment-oriented are bullish on the U.S. stock market, on the U.S. economy. They think everything is great. I saw a guy from the Cato Institute on CNBC today debating somebody, about China and a trade deficit, and his conclusion was, it's great. And so it's just amazing to me that so many people who, should understand and should know better, still can look at the American economy and look at the trade deficit and the current account deficit and look at our lack of savings and look at the housing bubble, look at all these things, and come to such ridiculous conclusions that everything is fantastic, that we've got this great economy, and that there's nothing to worry about. It really bothers me that, and what's interesting is when I find people that tend to agree with my outlook about understanding that there's a problem, the people who are agreeing with me are people who I completely disagree with politically, who are much more to the left, who are much more interested in big government and government solutions rather than free market solutions. And some people might think, well, maybe I should, rethink what I'm thinking. Maybe I'm the one that's wrong. But I just somehow can't come to those conclusions. No matter how I look at it, I can't see their point of view. I can't see that there's any chance that they're right. The one person who kind of did agree with me who was there is Ron Paul, who's running for president. I mean, here's an example of a guy who's a libertarian-oriented guy who sees a problem, who thinks there's a crash coming, that thinks the dollar is going to collapse, that knows that we can't keep borrowing money to consume. So, I mean, at least I've got a guy like that. And I did make my first political contribution to a presidential candidate. I gave him a check for the maximum that I could, $2,300 towards his campaign. And Ron Paul was interviewed on Stephanopoulos on ABC, and he's now got about $2.5 million in the bank, and he's got more money in the bank now than John McCain. He's number 3 as far as money in the bank. I mean, he's way behind the Giuliani and Mitt Romney, but he's number 3 right now. And I am intending on sending out a letter. I'm working on it to my database, encouraging people to donate. But I think anybody who's listening to this show should give him a check for $2,300. Go to Ron Paul, because I think I don't think he's as big a long shot as people think. I mean, I think that there's a lot of people fed up with mainstream Republicans. The guy's getting a lot of support. They just had a straw poll up in a part in New Hampshire, and he got 65% of the vote. When people hear his message, I think it's resonating, and I'd be interested to see what can happen if we actually gave this guy some money, because the money would not only let him campaign more, But it would let the media notice him. Plus, he gets a lot of volunteers. A lot of people do stuff for free because they really believe in what he's saying. Because, I mean, all the other guys, who cares who wins? I mean, it's not going to make a difference. But at least Ron Paul, he actually might make a difference. And in a worst case, at least we'd have an honest man in the White House, which would be, I don't even know if they'd let him in. But, yeah, I mean, so I think it's definitely worth, $2,300. I mean, what's that? A big screen TV? I mean, just give it to him. Don't give him $50 or $100. Give him the full amount. I mean, see what he can do with it. I think if you don't, I mean, the dollar's going to be practically worthless in a couple of years if he's not president. So so what the hell? Anyway, speaking about the dollar, today the dollar finally made a new all-time record low against the euro. Now, obviously, that record doesn't go back very long because the euro hasn't existed that long. But the euro has now hit 138. The British pound is above 203. It's a 26-year high. The last time the British pound was this high, I was still in high school. All right, it was 1980. And it's going higher. I think the British pound has no resistance now until 240. The Canadian dollar was backed off a little bit today because they raised interest rates a couple of days ago. But the Canadian dollar is around 95 cents. I mean, I think it's going to go over $1. The big dollar index, I'm talking about that dollar index, we're at about 80.5 right now, the dollar index. We're 1/2 a point away from that critical support level that I've been talking about since I first started this show over 2 years ago. But this is the lowest the dollar has been. I've been doing this show for over 2 years, telling people to get out of the dollar, and this is by far the lowest it's ever been since I've done the show. So it's at a new low against all these currencies. And, once we fall below this 80 level, I think that's it. I think it's just going to get killed. I mean, I really believe that at an absolute minimum, the dollar index is going to go down to 40. That's half of where it is right now. That means the other currencies double in value by definition, from where they are now. Which means the euro doesn't stop at 138. It goes to, almost $3. 130 double is 260. But, and I think we're very close to a major free fall. And look at what's going on. Finally we're starting to see S&P and Moody's are now downgrading a lot of this debt that had, high ratings, which I knew. We put that partnership together and we shorted these triple B minus tranches about 6 months ago. And they were trading at par 101, 102. Now they're trading at 50 cents on the dollar, but when we shorted them in that partnership 6 months ago, they were at 101 or 102. Now when I first heard about them, I thought this, 101, they're worth zero. They shouldn't have been rated triple B. They should have been rated triple F. But there are bonds that they've rated A, in double A, which I think could be worth zero. I mean, this is, these collateralized CDOs, these collateralized debt obligations, are the equivalent of the internet stocks of the 1990s. People forget. People have a very short memory about Wall Street and what these guys actually do. But during the 1990s, Wall Street made up, created these crazy companies. They brought them public. They slapped billion-dollar market caps on them, and their analysts put strong buy ratings on them. Well, they did the same thing with these collateralized mortgage obligations. They packaged worthless junk, subprime mortgages, and they wrapped them up with a pretty bow, pretended they had value, and they got their buddies at S&P and Moody's to slap high credit ratings on them, just like they got their analysts to put buys. And they were all in bed together. It's all nonsense. It's just starting to fall apart now. And, the market, the Dow has dropped a little bit from its highs, but it hasn't sunk in yet. You can look at some of these the TV shows I've done recently, and the interviewers, they keep telling me. Like I did Fox. I did Cavuto yesterday on 4 o'clock on Fox, and he again asked me. He says, "Well, Peter, if what you're saying is true, if there's all these problems with subprime, why haven't we already collapsed? Why hasn't it already been a disaster?" They think that it happens instantaneously. It takes time, especially when people are so complacent and reluctant to admit, and everybody is trying to cover it up, and Wall Street, is trying to pretend that these bonds have value. That's why Bear Stearns bailed out that hedge fund, because they didn't want the hedge fund to have to sell the bonds. So Bear Stearns bailed them out, and they drilled the bonds from the hedge fund to their own account. Those bonds still haven't been sold. They're not marking under the market because they don't want anyone to know what the market is. But now when Moody's and S&P start downgrading them, that's going to change the prices because now they're going to have to price them lower to reflect the lower ratings. One of the interesting things, Moody's now or S&P, they had a quote yesterday. They said that one of the reasons they want to change the ratings on some of the subprime debt is they said we have inaccurate ratings because it was based on false data that we got, and so that's why the ratings are bad because the data was false. Like they're trying to say it wasn't their fault. They were rating it based on false data. Well, of course it was their fault. They should have known the data was false. That's part of the whole problem. When you let a guy buy a house with nothing down and then you give him a stated income mortgage, right? Should you be surprised that the income that they stated was wrong? I mean, the lenders didn't call these things liar's loans for nothing. So you don't think Moody's should have said, wait a minute, these are liar's loans. Why are we going to assume that they're not lying when the brokers say that they're calling them liar's loans? So it's disingenuous for S&P to say, oh, well, it's not our fault because we had faulty data. I mean, they should have known the data was faulty. They should have challenged it. But again, it's not just these subprime mortgages. Remember, there's a lot of mortgages that, where people did document their incomes. But what happened was, and Fannie Mae and Freddie Mac admitted this, and no one is talking about this huge problem that there's going to be in the conforming loans that are guaranteed by Fannie and Freddie, because all the people who took out adjustable rate mortgages who had teaser rates, they were able to qualify as a conforming loan if they were able to afford the teaser rate. Right? They didn't care if they could afford the reset. They only qualified them on the teaser rate. So there are plenty of non-subprime loans, prime loans to credit-worthy borrowers, or at least that's what they think, who have no prayer in making their mortgage payments once they reset. No prayer. And, I hear people talking about, and I'll get to the calls in a minute. We got 3 calls on hold. People are estimating how bad these losses are going to be. And, the highest estimates I've seen is like $50 billion. And they talk about, $50 billion, that's a lot of money. I mean, whatever the highest, I'm sure it's going to be more than 10 times that bad. $500 billion to me doesn't even seem to be enough. I mean, there's been $5 or $6 trillion worth of mortgages taken out. To say that $50 billion is all that's going to be lost, I mean, that's amazing that anybody would think that that's it. It's going to be so much more than that. And again, of course, people forget to extrapolate the effects on the economy and the extra losses from the destruction of all that home equity. And that's coming. I mean, that's the next shoe to drop. We've had in the last few days several more firms. Ryland came out today with big losses. Beazer, Alvanian, all these companies are coming out with huge losses. Prices are falling. Of course, the government tells us that new home prices are still near the highs, but the home builders are saying a totally different story. But recently, look, yesterday we had disappointing news from Sears, disappointing news from Home Depot. Both stocks dropped sharply. What's the disappointing news? Weaker than expected sales. Blamed on what? Softness in the housing market. It's just starting. It's going to get a whole lot worse, and so the losses are going to be much bigger. Anyway, let me quickly take the calls. Let me get off the telephone number 2. For anybody else who's thinking about calling, 888-678-9597, 888-678-9597. Also, just want to mention oil again is back up to $73 a barrel. $73 a barrel. It's within a few dollars of the record highs again. And remember, when I first started doing this show, where was oil? I mean, what was it in the 30s or in the 40s? And I'm pounding the table, buy oil, buy oil, buy oil. Look where it is now. So oil's at near the highs, the dollar's near the lows. That's basically what I've been doing for the last couple of years is telling people to get out of dollars and then, as a side note, get into the commodities, particularly oil and also precious metals. Gold's around 650, well above where we were 2 years ago, but quite a bit off the highs. We still need about $60 or $70 to get to the highs from last year. But I think we will do it. I think we'll do it soon. Anyway, let me take Ken from Minnesota. Go ahead, Ken.
I heard today an article that a record number of observers are expecting like a 10% correction in the U.S. stock market. Would you be one of those? Do you think that what do you see is the greatest threat to?
Oh, I don't agree. I'm looking for something much worse than 10%.
What do you think would be the greatest threat right now?
To what? The market?
Yeah.
Well, I mean, there's a number of them, but I think the most significant threat is going to be the breakdown of the dollar. If the dollar breaks this key support level, it will cause interest rates to rise sharply. It will cause inflation to accelerate, and it will crush the stock market and the economy and the housing market. I mean, there's no way around it. So they can't stop the dollar from crashing below the support line. It's going to bring on a major market decline. I mean, there's no way around it.
I always hear people say a weak U.S. dollar is good for if you invest in U.S. companies that do business abroad. They benefit from the weak dollar, so that's a good way.
They benefit from it in partially, but in other ways they suffer. So it's not necessarily a win-win. But the bottom line is, even if they earn dollars, even if they earn more dollars, they're earning more dollars that have less value. You know, one of the shows I was on, that Cutler last week, and when I talked about the dollar going down, one of the guys said, "But that's a good thing." He said, "That's good for America because it means our assets are lower priced." Well, what's good about our assets? It's like, is it good if your house loses value because now your house is at a lower price? If you buy a stock and it goes down, that's a good thing because now it's a better value? Or like if you get a job and your boss gives you a pay cut, you should be excited because now your labor is a better value? I mean, it's all nonsense. When the dollar goes down, if you own dollars, you're poor. You're worse off. If you collect a paycheck in dollars, the value of that paycheck declines every time the dollar loses value.
But in relation to the question of the possibility of a 10% correction, I'm just wondering because, like, over the last 2 years, the dollar has been sliding down constantly while the stock market has been going up.
Right, yeah. Now, of course, in terms of other currencies, the stock market hasn't been going up. It's actually been losing value. It's been going up in terms of the dollar. But I do believe, though, that if we get a big breakdown in the dollar, right, I mean a big breakdown where we break below these support levels and it really starts to drop, given where interest rates look like in the chart on the 10-year and the 30-year, long-term interest rates are now rising. And that's what's going to crush the market. It's going to be a big move up in interest rates because then the Fed's out of the picture. People realize the Fed's going to tighten. The big move up in interest rates is going to crush the economy because now all those mortgages that are resetting are going to be resetting at even more expensive rates. I mean, that'll be it. That'll be the end of it. It can't survive. So, in that respect, maybe they're going to have to pull out the stops to keep the dollar from falling, but I don't really know what they're going to do because we know it's not going to be interest rate hikes. So I don't know what it's going to be. Are we going to be able to lean on foreign central banks? Are we going to get are we going to get the European central banks to intervene and sell the euro? I mean, I don't think so.
But even if you own, say, oil stocks, like when we had a correction back in February, that 3% in one day, the oil stocks went down and gold and all that just with everything else. So shouldn't a person just get out of that market entirely if he expects a correction?
I don't think so. I mean, because, just because it went that way one time, I think eventually stocks are going to collapse and gold's going to go up and gold stocks are going to go up. But meanwhile, I know the oil stocks have all made new highs. They've all made new highs and then some. So I'd rather own my oil stocks and my gold stocks and my defensive stocks than own U.S. currency. I think U.S. currency is about the riskiest thing to own, so I wouldn't want to own it under any circumstances. I certainly wouldn't want to own, U.S. bonds. They're even worse. Now, you can own foreign currency or foreign bonds, but I still prefer the equities because I still think that there's a lot of inflation around the world that isn't, being accurately reflected in the markets. And I think when it does, we're going to be better off owning stuff than owning paper.
But if you're really expecting a correction and you don't have to...
I'm expecting a bear market. I mean, I expect a much bigger decline than 10%. But I think oil prices are going to go to $150, $200 a barrel. So I still think it makes sense to own oil stocks because they're still cheap, especially if you own international ones. But I also like the very defensive stocks that we buy at Europe Pacific Capital, like commercial and industrial property, like refineries, like pipelines and infrastructure companies and utilities. I mean, I'm still buying these yield-oriented stocks. I still prefer them to paper money.
But can't you have oil prices going up, but the stock prices going down?
You could, but I mean, what difference does it make? I mean, so what if you own a stock and it goes down? I mean, I'm buying them for the dividends. It doesn't really matter if it goes down. I'm not going to sell. The real risk is somebody has a bunch of cash and the cash is worthless. Then what are you going to do?
I don't know. I'm trying to figure it out.
Yeah, well, do you have an account with us yet?
No, sir, I don't.
Well, call up, talk to one of my brokers, and they'll help you. But you got to get your assets protected, and you got to get out of dollars.
Oh, okay, thank you.
All right, thanks for the call.
Bye-bye.
Let me take a quick break, and I will pick back up on the calls, including one that's holding from Germany, so we'll skip to that one. But the commercial break will be back in 1 minute.
Euro Pacific Capital is an independent brokerage firm on a mission to inform its client base and prospective clients about economic and market events that could affect their financial security. Euro Pacific Capital seeks to provide solutions which are intended to provide safety, not risk. Solutions designed to protect our clients and their families from the U.S. government and its inflationary practices. The time to act is now, while you still have the opportunity to get your money out of the dollar. It's legal to do so, and after a consultation with one of Euro Pacific's brokers, you will understand how this decision could ensure your financial security. We offer a full array of services ranging from retirement and trust accounts to complete financial planning, checking accounts with or without debit cards, and life insurance, even annuities. With our independent, no-nonsense investment advice that's a cut above the run-of-the-mill commentary that is passed for research for far too long on Wall Street, we suspect investors will find a home at Euro Pacific Capital.
Okay, I am back. Let me go straight to the phone. I think it's our friend Will from Hamburg. Will?
Hi. Can you hear me, Peter?
I can hear you. Go ahead. Are you there, Will? Well, I think I lost Will. Is Mark there from California?
Hello?
Is anybody there?
Mark from Northern California is here.
Hey, Mark, what's going on?
How you doing, Peter?
Good.
The book is great, Crash Proof. You're a true patriot. I've read it several times now. It's just incredible.
Thank you. Did you buy some extra copies for your friends?
Well, I'm going to. I've recommended it to a few friends, but I have a friend who's already shorting a lot of those mortgage-backed security bonds, so he's already onto it, and I don't know if I think he already understands the message.
Yep.
And I just had a question. I've made a lot of adjustments based upon your analysis, and I bought like GLD, and I bought a lot of ETFs through iShares, around Asia and whatnot, away from the United States. Can you comment on, in terms of the risk there?
In where in particular?
Well, in terms of, I read in your book that you really want people to buy the actual securities in the actual stock markets. I have a discount broker, and I've used that to buy a lot of the ETFs. Like WS.
ETFs. It depends on what the ETF is. There's a few of them that focus on, conservative, dividend-oriented types of stocks, and those would be the ones that I would favor. But, as I said in the book, and what I've been done through Euro Pacific Capital is I prefer to pick the stocks myself and kind of create my own ETF for my clients, just buying them individual stocks and holding on to them. Just not buy a prepackaged stock selection, because what if I don't like somebody else's pick? So I would prefer to customize my own portfolio and be in charge of it, not just buy something. And then if all of a sudden the managers, if they start to change it or do something you don't like, then you might have to sell it, and there might be some adverse effects of that. So make sure it's not a terrible strategy to buy foreign ETFs. But it's just not, what I'm doing. And I don't think people are paying me commissions to trust somebody else's judgment. They're paying me because they want my judgment. They want my advice. So, I'm going to find stocks that I think will do well given my outlook for the global economy, my outlook for these companies and countries. I'm not going to trust that decision to some third party.
Yeah. And then you were commenting about Bear Stearns. I think anybody who invested in that fund, the title of that fund was the High Grade Structured Credit Enhanced Leverage.
It's almost like a government program. Whenever the government names a program, whatever the name of the bill is, the actual function is the opposite. Like tax simplification bill will be the tax complex. But Yeah, I mean, they give it these names, I mean, and, you know, to try to create the air of safety. But, you know, I talked a lot, you know, about my book about how the hedge funds and all these phony profits, they really should call them risk funds. But there was, another hedge fund, apparently, that had been investing in these types of mortgages, had great returns. Like last year it made 40% or something. But now this year it was down about 5 or 6%, a couple weeks ago. And so some of their larger shareholders, about 1 or 2 of their shareholders, wanted their money back. So they said, I'd like to take my money out now, right? And basically the fund said, you can't take it out, and they shut the fund to redemptions because they can't sell these things. So, I mean, what that really means is that the profits they made last year aren't real profits because they didn't sell anything. They pretended they had profits. But, of course, they didn't pretend to charge a 20% incentive fee. They really did that. So I said a lot of people who invested millions of dollars in the hedge funds are going to lose it all. Yet the hedge fund managers got rich.
Yeah, that was
and it's going to be exactly the same way. A lot of people started .coms, companies. A lot of people started, these internet companies in the mid and late 1990s, and the companies ended up going bankrupt. They never made any profits. The stocks went to zero, right?
Yeah.
The people who started these companies left multimillionaires, in some cases billionaires.
Yeah, that's just sick.
But it wasn't because they made any money for anybody. They just made money for themselves. And that's going to be the same situation with a lot of these hedge fund general partners. They're going to end up losing all their clients' money but walking away rich.
Yeah, that's just not right. That's not right. Yep. Well, I also had a pretty interesting new home development little story for you. I went to a free concert of Don McLean a couple weeks ago out here in Northern California. And it was put on by a home developer in the middle of all the model homes. And he did about an hour-and-a-half show. He sang Bye Bye Miss American Pie.
Mm-hmm. Well, that's appropriate.
And I have to tell you, he did about a 15-minute rendition of that. And they also had a vintage car show and whatnot, free food and drinks and everything, trying to push these houses. During the 15-minute version of Bye Bye Miss American Pie, I was sitting there thinking, this is incredibly ironic that he's singing this song and they can't push these 4,000 square foot, 800.
It's done, and they're still building them. They're constructing them, and that's just making it worse. The industry is still manufacturing houses when they can't even sell the ones that are already there. Right now, the supply of empty homes, single-family homes, unoccupied, is at a 51-year high, and it's at a 51-year high because they've only been keeping the statistics for 51 years. So it's probably the highest in history. But not only are there all these homes that haven't been sold that are empty, but there's a lot of homes that were bought in the last few years by people who can't afford them, so they're going to be back on the market, or by people who really didn't need them, like vacation homes where people live in them maybe 2 weeks out of the year. They don't need these homes. They bought them because they thought they would make money on them. When they realize they're not making money on them, they're going to want to sell them.
Well, it's amazing. I'm looking out my window right now at a house that's going to be auctioned. It's only 2 years old. And across the street, they're building new homes. It's mind-boggling where I live. I live out at the edge of the Northern California Bay Area development out near the Central Valley. And it's just, I drive around, and my wife bugs me about it because I keep ragging about it. How it's just incredible. What could they possibly be thinking? But,
on my website, in the articles, there was a great article, I think I put it up on there yesterday, about some foreclosures in Atlanta. And if you haven't seen this story, it was on my website, I think it's a July 10th day. Let me try to find this one.
I'll look for that.
But basically, I'm looking for it right now, and it had to do, they went over some prices of some of these houses that sold in foreclosure and down in the Atlanta area. And the prices were just incredible. If you looked at them, basically, here it is. New York Times increases. It was a New York Times story, basically, and it says increasing rate of foreclosure upsets Atlanta. And basically, they go over. There's 2 houses that they actually go over. Okay, one of them. Okay, the guy bought the house brand new, 3 years ago for $330,000. Brand new house, paid $330,000 for it. It just sold in foreclosure 3 years later for $134,000. Wow.
134,000 from 330. And then the other one that they talked about in the article, this house was bought for $255,000 in the summer of 2004. Okay, $255,000. $255,000. It just sold in foreclosure for $78,000.
Oh,
okay, these are 60-70% declines in home prices in Atlanta. Now, if a $255,000 house can go to $78,000, imagine what $1 million place can go down to.
Yeah.
These $2 million places. I mean, these are moderate homes. You know, and can you imagine a guy that bought this house? Somebody bought the house for $255,000. Were they thinking in their wildest dreams that 3 years later somebody could buy this identical house for $78,000?
No, it's delusional. It's just delusional right now.
But people just haven't put two and two together across the country yet. People don't realize what their houses are worth. And what this is going to do, because for the last few years, when people took out home equity loans, okay,
yeah,
people didn't think they were borrowing money. They thought they were spending their own money. They thought that their home equity was their money. It was like the bank. So when people took out $20,000 or $30,000 and bought a new car, they thought they were paying for it. They didn't think they were borrowing. They thought they were using their home equity.
Well, that your book is basically, your theme of your book just pegs that. It's incredible. I just don't get it.
And what's going to happen now is all of a sudden the home equity is going to be gone, but the mortgages are still going to be there.
Yeah.
So this is all, I'm surprised that I don't get more credit. I go on these shows, and I was on a radio show today, and the guy's like, well, you've been consistently wrong, and I go on these shows, and they say, like, these guys like Lufkin, or, this guy Don Lufkin, you're consistently wrong, you're wrong. I was like, wait a minute, I'm the only one that's been consistently right. What have I been wrong on? Tell me.
I know, you're very...
There's so many calls on so many things, and people still don't understand that I know what I'm talking about.
Yeah, Erin Burnett's body bag comment was I just almost fell out of my chair. I thought, how can she say that? That's just...
Yeah, they think my clients are losing money. I said, you got to talk to my clients.
I know. I don't know. It's just because, they want to push the U.S. That's what they do. They're an infomercial. And that's...
Oh, no. Anyway, well, thanks for the call, Mark. I know I got a couple more guys. I got the guy from Germany back on the line, so...
Okay, Peter. Thank you.
All right, Mark. Okay, let's see if we can talk to Will again from Hamburg. Go ahead, Will.
Peter, you there?
I'm here.
Excellent. Finally, third time's the charm, they say, right? Quick question for you. I just finished your book recently, and it's pretty obvious that the housing prediction is proving true, along with a few other things that you term pins. And I was hoping that for myself and for the other listeners who might have just finished reading the book, if you could maybe highlight a few of the other pins that have happened in the time since it was published, because I think the copyright is 2007, but you make multiple references throughout the book to it having written it in 2006, and I was wondering if you could highlight a few of the other pins that have appeared.
Well, I mean, I did get to, tweak it a little bit. Yeah, I started writing it came out in February of 07. So, yeah, almost all the writing was done in 2006. But, I mean, the only thing that's really happened so far, I mean, is what's happened in the housing market, because we've seen the blow-ups there. I mean, I talked about these mortgages, and I talked about the securitization in Wall Street and how all this stuff was going to blow up, and I talked about the fact that, credit was going to contract and lending standards were going to tighten and credit was going to dry up, and all that stuff has started to happen. I mean, what hasn't happened is that prices haven't collapsed yet for housing, and we haven't moved into a recession yet. I mean, that stuff is still, it's still going to come. I mean, it's one domino after another. But it's pretty much playing out the way I said it would,
No, completely. Like I said,
we've also seen the dollar continuing to weaken, and I predicted that would happen. And since the dollar is at record lows right now against all the currencies, it's certainly lower than it was at any point when I was writing that book. So, we've had continued weakness in the dollar, but, we haven't had, also interest rates. I did predict interest rates would rise, and they have risen, but they haven't risen, that substantially yet that, it's become problematic. And this U.S. stock market is still, making new nominal highs. And, we're not in a recession yet. I mean, people are still optimistic. So, most of the predictions that the book is making have yet to happen. But, over the next year, we'll see what happens. I mean, because you don't know, it doesn't happen overnight. And I can't, you can't say this is exactly how it's going to happen. Because so many people are still in denial. They still don't understand that there's a problem. I don't know what, a safe has to fall on their head before they understand.
Yeah, I mean, the caller prior to me was hit the nail on the head. I've watched a lot of the archive videos, and it just seems like they have no clue. And it's really interesting when you live abroad, when you can see the propaganda that is in the American media and how censored it can be compared to the international media outlets. And watching those videos, it really rings true. My second quick question was, so now, people have read the book, they're convinced, they want to get into investing in these international stocks and possibly through Euro-Pacific Capital. I just wanted to see if you could outline what a typical consultation might consist of for potential clients when they do call up the number that's on the website and talk with them.
Yeah, I mean, basically when you call up, you're going to speak to one of my brokers. Occasionally somebody will speak to me, but, more often than not you'll speak to somebody other than myself. But basically, we'll ask you some questions and try to find out, where you are, what kind of investments you've already made, what kind of accounts you have now, where you are you still working, or, are you retired, how did you hear about us, a discussion about your background, what your assets are. And basically, recommend, a course of action. And it's pretty similar for most people. And we want to find out whether or not, where are you? Do you want to speculate? Do you want to try to get rich off of what's going to happen? Or do you want to just preserve your wealth and not go broke? And we can help portfolio to you, based on what your objectives are.
No, certainly. Okay, great, Peter. Thanks for answering those questions for me.
Well, thanks for the call. And we do take accounts from people in Germany, all over the world.
It would be a U.S. account, but if I do have some money for you, I'll give you a call.
Okay, looking forward to it. And if you have euros, transfer them in. We can take you can send in euros. Any currency that you have, you can send it in. You don't have to convert it to dollars.
Oh, perfect.
You can fund your account.
Peter.
Okay, thanks for the call.
No problem. Thank you. Bye.
And I think I've also got Jason on the line from our neighbors to the north, the Canadians. How you doing up there?
I'm very good. How are you?
Hey, do they talk much about in Canada about the strength of the Canadian dollar and it's approaching parity with the U.S. dollar?
Absolutely. I mean, it's hard to ignore.
They don't even talk about it at all here. I mean, they mention it briefly once in a while on a financial channel, but I've never heard it mentioned on any national news show.
Well, it's hard to ignore when you see the gains that it's been making in the last, I guess.
Right. Well, the flip side of those gains are our losses. But I'm wondering if it's even going to be a story here when the Canadian dollar does go through the U.S. dollar.
Well, it's getting really close to parity now. I think it's like 95 cents or something.
Yeah. I think it'll be over $1 by the end of the year.
That certainly seems to be a possibility if it keeps going in the direction that it's going. I mean, as you said on one of your archives, I think it made a 10-cent gain in 10 weeks. I mean, that's crazy. But I had a question for you in regards to the obviously, it's big news up here about what's happening with the real estate market in the States, and I'm just curious what your thoughts might be on how, obviously our economy has been very closely linked with the American economy for forever, and I'm just curious as to what your outlook on how the Canadian real estate market might fare in the...
I think, look, I wouldn't want to own residential real estate any place they speak English. I think all real estate in all these countries, residential is overpriced.
Right.
I think residential real estate is going to come down worldwide. Okay, so it's just not going to perform very well.
Mm-hmm.
I think the real estate market in Canada is going to suffer. I don't think it will suffer as much as the real estate market in the United States, and I do think the Canadian dollar will gain value, at least relative to the U.S. dollar. So you're not going to have as many foreclosures in Canada as you're going to have here. The Canadian economy is not going to be nearly as negatively impacted.
Mm-hmm.
But I don't think that real estate is going to rise in value. I think it's going to fall.
Right. Well,
I wouldn't look at it as an investment. It doesn't mean that you can't buy a house there and live in it. Although I think that if there are single-family homes to rent, and you can find one that you like, and you want to live in a single-family home, and you can find a rental available, chances are you're better off renting it. But you can make a comparison. You compare what you can pay in rent versus, what the cost to buy it was, and make a decision, and just don't assume any appreciation. I mean, one of the reasons that a lot of these rent versus own calculators, when the realtors always try to tell you, well, what's cheaper, renting or owning?
Sure.
The only thing that makes owning cheaper is the appreciation that they all assume. So the minute you take the appreciation out of the equation, renting is always better.
For sure.
So if real estate isn't going to appreciate, and I don't think it will, then for now it makes sense to rent, unless you can't find something that you like that's rentable.
Well, it's interesting. I mean, just reading the papers here, in the business sections, it's constantly talks about how we have, in Toronto, that's where I live. We're amidst a burgeoning real estate market, and prices are strong, and they're still going up, and we're making percentage gains and everything in the local market. But I'm just wondering whether this is just whether, as they say, when they sneeze in the States, we get a cold in Canada. And whether or not we're sort of gearing up for something similar, like what's been going on there. And I think it's certainly interesting to watch. And from my perspective, I think things are just sort of heating up in the States in terms of where the real estate market is heading. Certainly, based on everything that you said in your book, I think we're just sort of seeing the beginning of what's happening. And I'm just, I guess, a little fearful. Based on what my interests are, having a substantial equity tied up in my home, I'm just wondering whether or not, they get out while the getting's good, or whether or not,
Look, if I were you and I had a lot of residential real estate up in Canada, I'd try to sell some. I just think there's better places for your money. I think you're better off, having your money in resources in Canada, having your money in mining in Canada. I think residential real estate is just not going to be a good performing asset to own relative to other things that you can own instead.
Okay.
And I'd rather own commercial real estate there. If you must own real estate in Canada, own some commercial. It's better, or industrial, or something like that. Or farmland, or agricultural land will do well, or But I just don't think if you just have land with houses on it or apartments on it, it's just chances are it's overpriced.
Right. Okay. Well, that answers my question.
All right. Well, thanks for the call.
Okay. Thanks a lot.
All right.
Bye.
Okay, again, the lines are cleared. Let me give out the telephone number again. We'll take a quick commercial break. It's 888-678-9597, 888-678-9597. We'll take a quick break, and we'll come back for the last segment.
Euro Pacific Capital is an independent brokerage firm on a mission to inform its client base and prospective clients about economic and market events that could affect their financial security. Euro Pacific Capital seeks to provide solutions which are intended to provide safety, not risk. Solutions designed to protect our clients and their families from the U.S. government and its inflationary practices. The time to act is now, while you still have the opportunity to get your money out of the dollar. It's legal to do so, and after a consultation with one of Euro Pacific's brokers, you will understand how this decision could ensure your financial security. We offer a full array of services ranging from retirement and trust accounts to complete financial planning, checking accounts with or without debit cards, and life insurance, even annuities. With our independent, no-nonsense investment advice that's a cut above the run-of-the-mill commentary that is passed for research for far too long on Wall Street, we suspect investors will find a home at Euro Pacific Capital.
We're back. And again, the number to call, 888-678-9597. 888-678-9597. Again, getting back to the theme of, people are looking at the problems, that's happening in the subprime market, and thinking that it's just this, confined to subprime, it's just a small little thing, without realizing that subprime, again, is just the tip of the iceberg. It's not just subprime, it's the whole entire process, it's the whole bubble. But the fact that so many people just don't understand the significance of this and think that just because, we all know about it, and the Dow is still at 13,500, that everything is fine. No, it doesn't. Because, look, you remember when we were shorting these subprime bonds 6 months ago, they were still at par. It was obvious to me that they were worthless, but they were still at par. So just because, you can see there's a problem doesn't mean it's reflected. And believe me, the assets that are out there are still mispriced. All of these bonds that are out there, and there's hundreds of billions or trillions of dollars worth of them, are being mispriced. And there are tremendous ramifications when these things become realistically priced and when people have to start selling them. Because, there are funds that own some of this paper that when it gets re-rated, they're not going to be able to hold them because now they're going to be too low a rating and they're going to be required by prospectus to sell them. Well, again, when you have your house on the market, you put a for sale sign out there, if you don't actually have to sell it, you can write whatever you want on that for sale sign. You can pretend all you want that your house is worth what it says it is on that for sale sign. But what it's actually worth is what happens when you sell it. And the houses that we just mentioned, the ones that were down 70% in Atlanta, I'm sure when the people who initially owned those houses before they went into foreclosure, I'm sure they put for sale signs up and they tried to sell it for some $330,000 or maybe more because they tried to probably sell it for more than what they had paid. I mean, if they had paid $330,000 for it 3 years ago, I'm imagining that, the valuation of that house at the peak was probably $400,000, $500,000. I'm sure that's what the person thought it was worth. I mean, right? 3 years of appreciation? It's got to be up at least in the 400s. Again, it ended up selling for what, 130 or whatever it was. Because that price was real. They actually had to find a buyer right then and there. And, that's what's going to have to happen. And the appraisers, the whole appraisal industry is going to have to change because when there's these new homes that are built or somebody wants to buy a house, the appraisers are going to have to look at these foreclosures, look at the glut of houses on the market, and the appraisers are going to have to come back and tell the sellers and the buyers, you know what? We're not going to validate this appraisal. We're not going to say this house is worth $500,000 because you know what? If we loan you the money and you don't pay us back and we have to sell it, we're not going to get anywhere near $500,000. So once the appraisers are like the Moody's or the S&P, right? When they put a AAA rating or a AA rating, they're basically appraising a bond, right? They're saying, we've looked at this bond, we've studied the credit quality, and we say it's AAA. Well, now what's happening is they're coming back and saying, you know what, we've taken a second look, and it's not AAA anymore, it's BB or whatever it is. Well, that's what the appraisers went at these houses and basically rubber stamped prices on them and basically said, oh, okay, you guys, you're selling this house for $500,000 and he wants to pay $500,000, fine. We're saying it's worth $500,000. The appraisers are going to have to come back and they're going to have to, really look at these situations and they're going to come back and say, you know what, it's only worth $300,000. So, buyer, if you want to buy this house, we're not going to loan you $500,000. We'll loan you $275,000. You got to come up with the rest of it yourself. And of course, once the appraisers start putting honest appraisals, the transactions are not going to take place because the buyer's not going to buy the house when the bank tells them, the appraiser tells them it's only worth $275,000. So the same thing is going to happen. All of a sudden, these bonds that were rated AAA, when the Moody's comes back and says it's not AAA anymore, it's BBB. Well, what happens to the price, right? The price isn't going to stay the same. The price is going to collapse. They're not going to say, well, I'm not going to pay AAA prices for that, BBB bond. So, I mean, this is all going to be happening. This is all going to happen. I mean, I guess the truly amazing thing about it is that people can't see this. They just cannot. They can't see it. I mean, that's going to be, and I think I've said this before, but obviously some historians are going to write books about this time period and about what went down. And when people read it 100 years from now, they're not going to believe it. I mean, people are going to say, oh, you're making this up. There's no way people were this stupid. This couldn't have happened. It couldn't have happened like that. I mean, it's like when we look about, we read about the Salem witch trials, and we read about the other, popular delusions and things that people believed in the past and things that, and we think, well, how could that be? How can people be so stupid, Well, now you know. This is how they can be that stupid. We're living right through it. Anyway, I've got another caller on the line, Matthew calling from Maine. Go ahead, Matt.
Yes. For Unfortunately, I have a lot of wealth stored in a 401k plan, and it's really hard for me to pick a lot of plans. So for keeping wealth intact for, let's say, a 6-year time horizon, is it better to split all the funds between international equity and international mutual funds, or should I keep some money in cash equivalents and try to time the market should the international equities?
I generally tell people when they can't transfer money to me and it's tied up in some kind of 401k and you've got a selection of mutual funds, basically what I recommend is look for any natural resource funds, number one. If they have a natural resource fund or an energy fund or precious metals or some combination, and definitely buy some of that. Then look for the international funds. And if they have an international, yield-oriented fund or a conservative, growth and income, but it's foreign, definitely take that. Or, even if they have an emerging market fund, take that. Try to get, if they have a foreign bond fund maybe, try to get into all the different foreign classes, but don't own anything domestic. Now, if you have to go domestic, look for some kind of domestic, resources again, or, export oriented, if you can take a look, if you can see what the portfolio is, you want to own the stocks that are global in their scope, where they do as much business outside the country, and if they sell products that with a global market, look towards that. If you have to be in the U.S., those are the kind of stocks that you want to own. The kind of stocks you want to avoid the most is you want to avoid the high PE stocks, things that are expensive relative to their earnings. And you want to stay away from anything that's sensitive to the U.S. economy or the U.S. consumer, which would be financials, financial services, lenders, home builders, big ticket, retailers, anybody whose earnings are a function of an American, using his credit card. All those companies are in trouble.
Yeah, most of the plans are pretty much all domestic with the exception of the Euro Fund and a national fund, so I guess I'd split.
Yeah, and you might have to just split it all into those two. I mean, that might be the only thing you can do,
Okay. Do you recommend keeping some in cash, or do you think at some point it would be safer to keep it in cash versus international?
I mean, if it's domestic cash, no. If it's going to be foreign cash, then I can see an argument for having a percentage there. But I don't see any real argument for U.S. cash, especially in a retirement account. I mean, the only thing that's going to retire is going to be the dollar. If you got your money in dollars, it's your money that's going to retire, not you.
Yeah. Okay. So pretty much no U.S. dollars at any point in time.
I don't think so. I think it's too risky.
Okay. Yeah. Okay. Thank you.
Okay. Oh, we picked up another call. I've got Darren from Arizona. Go ahead, Darren.
Oh, hey, Peter. How are you doing?
Okay. How are you?
Good. One of the blogs that I read online, an economist, Mike Shedlock, issues a global economic report. I pretty much read him every.
I'm familiar with it, but okay.
And he talks a lot about the hedge funds and the problems that are developing in them. And I'm curious, from your perspective, with what happened with Bear Stearns a couple of weeks ago, how close was that getting to a meltdown there? Because apparently I think they weren't even able to negotiate their holdings on about 11 cents.
Well, they weren't able to. That's why Bear Stearns bailed them out, because they couldn't find. They went to sell these bonds, and basically they were foreclosing. Right? It was like a foreclosure. They went to sell the bonds, and they didn't. And the prices they were going to get were so much lower than everybody was pretending that they were worth. That they decided not to do it. But now people are still in denial. They're still pretending.
Yeah, and so, but I guess my question would be then is how close? Let's say once these things start cracking, what is that really going to do to our economy? At that, I mean, is that going to?
Economy is done. It's finished.
Right. That would. Our
economy is funny. This whole economy for the past 8 years has been a complete farce.
Yep.
And, rather than, as I try to point it out to these guys, rather than being something to brag about, we should be ashamed of it. All we did is borrow money that we didn't have to buy products we couldn't afford. And we ran up a huge credit card, and we convinced ourselves that it was okay because our houses were gaining in value. It was all nonsense.
And I'm kind of curious because it looks like to me that we're really set up for another Great Depression type event. And
we are. I mean, we're set up for something really bad. I mean, and that's one of the reasons that my critics try to try to discredit me, because they say well, what I'm predicting is just so gloom and doom and so terrible that therefore it must be false.
No, and that's ridiculous.
I mean, sometimes things are bad. I mean, countries can go. A lot of countries, the history is filled with countries going through periods of very bad bad economic times. I mean, so it's not, just because that's going to happen doesn't mean that that I'm nuts.
No,
that's not predicting.
Not at all. Absolutely. I think those critics are unfounded. If I think they're ignoring the data. Essentially, is what they're doing. They have to be. I'm just wondering how much worse this would be, because there's one definite thing that's different from the Great Depression today, is that during the Great Depression, people weren't in debt up to their eyeballs like they are now.
Oh, I know. No, the economic fundamentals underlying our economy are much worse. So the conditions are set for a period of time worse than the Depression. Now, the thing is, a lot of the problems in the Depression, were man-made. I mean, obviously, the bubble, the boom that preceded the Depression, the 1920s, the Federal Reserve caused that. So the initial downturn was the deflation of the bubble that the Fed blew up in the 1920s. So we should have had a very severe economic downturn as a result of the deflation of that bubble. But the government itself is what turned that cyclical downturn, as sharp as it would have been, turned it into the Great Depression by a number of policy errors, by both Hoover and Roosevelt. Roosevelt, people credit Roosevelt for getting us out of the Depression. He didn't get us out of it. I mean, he helped prolong it.
Yep.
Hell, the Depression lasted for his entire presidency, and he was president for 4 terms.
Such as Smoot-Hawley Act and things like that?
It wasn't the tariffs. I mean, the tariffs didn't help, but the tariffs wasn't the main problem. But so obviously that we're going to have a bigger collapse than we had, I think, in the 1929. I think the collapse of the stock market, the real estate market, it will be worse. But now, will it turn into a Great Depression? It certainly has the potential, but I don't know if we will make the same types of policy mistakes. But I do know that the country is in worse shape. And probably our political leaders are just as foolish, if not more so, than the ones that were in office in the 1930s.
Mm-hmm.
So who knows? They might even make worse mistakes. So I don't know. I mean, I think I'm kind of being, optimistic and, rosy scenario. If I was really pessimistic, I would have already left the country. Because, I mean, it might not be a very good place to live.
I might,
but they might do.
I might be a little bit too conspiratorialist. I think all those people that own all those hedge funds are going to, when the system collapses, are going to suck the system dry and walk away with all the money. And all the people holding mutual funds will be left holding the bag.
Mm-hmm.
One last question, if I may.
Yeah, we got about a couple minutes.
Okay, Shanghai market, do you consider overextended in this, and if yes, how much?
Yeah, it is, but I think it's going to get more overextended. But, the way we're investing in China predominantly is through relatively conservative infrastructure companies, utilities, toll roads. We're mainly investing through, Hong Kong and through Singapore. So it's a much better way because the companies we're buying there are nowhere near the valuations of the mainland China shares. Mm-hmm. So if there is a major collapse in the Chinese shares, the stocks that we're buying, I believe, they might go down, but it won't be anything near like what could happen to China.
Okay, well,
there was a really substantial drop in the Chinese market, from here. I'd be a buyer of some of those shares. They're kind of hard to trade, but I'm very optimistic over the long term about the Chinese economy, and especially so once the U.S. dollar collapse gets out of the way and their currency rises and they can begin to have, a more stable economy where the emphasis is on satisfying the desires and the needs of the Chinese, not the desires and the needs of Americans who can't afford to pay for them.
Oh, okay, great. Well, thank you for your time.
Yeah, thanks for the call.
You bet.
Okay, we are coming into the last couple of minutes here, so just thank everybody once again for listening. Watch out. I think we're in some very, very interesting, potentially tumultuous times here with the dollar floating on the Mason-Dixon line. We're very close to a major collapse if I think we break through these support levels. I mean, just a little bit below it, and if we quickly get back above it, I mean, it might not be right away, but if we really slice through the 80 level and you see the dollar index trading at like 78 and change, look out. Because it can really, something can really happen. And, there's a lot more shoes to drop in this subprime thing. I called it one of my columns a centipede. And, it's going to be snowballing. Look at these home builders. I mean, these things are all on 52-week lows. A lot of these home builders now are down 70 and 80% from where they were a year or two ago. 70 or 80%. Those are huge declines in these home builders. And how people can think that these home builders have lost 70, 80% of their value, yet the homes they were building are still at the peak of their value doesn't make any sense at all. It just makes no sense to think that. The homes have half gone down because if the homes are still so valuable, the people making them would still be worth a lot, but they're not. So this is huge. It's going to be big. Anyway, if you haven't done so, get a copy of my book. Read my book. I mean, all this is there. I laid it out in very simple, easy to understand terms, and it's great to show other people, show your friends, people that have written about this. Crash Proof, you can buy it in any bookstore. You can get it on my website, www.europac.net, EUROPAC.net. And again, and on the website, if you can sign up for the newsletter, you can read the special reports. And if you're not a client yet, there's still time. But don't wait for the dollar to collapse completely, because once that happens, that's it. Anyway, give us a call, 800-727-7922. Thanks again. I'll be here again next week, 8 p.m. Eastern, 5 p.m. Pacific.